2024 Stronger for Longer session. To take you through the presentation, we have Mr. Harish Strickland with us. Harish sir, it's all yours.
Thank you so much. Good evening, everyone. Wish you firstly a great 2024. Um, many of you know कि ये annual exercise जो होता है forecast का काफी time obviously प्रयास तो करते हैं कि we give a reasonable sense, but I think that it is more about what we are thinking today for the medium term rather than necessarily saying कि 2024 में ये सब होने वाला है. So with that kind of anticipatory bail, if I may, let me try and give you some insight कि हमारे हिसाब से 2024 and beyond how things are likely to pan out primarily for equity investments. So obviously any exercise of looking forward, I think it makes sense to look slightly backward to see कैसा गया पिछले साल. And while obviously numbers तो आप सबको पता ही है कि निफ्टी या सेंसेक्स ने 20% रिटर्न दिए हैं, मिड कैप और स्मॉल कैप ने anywhere between 40 to 50% रिटर्न्स दिए हैं. बट underneath those headlines, हमारे हिसाब से there were like 5 or 6 key striking things जो हमें भी सरप्राइज कर देता है from a market point of view, because when we sat out to make this presentation, हम भी देख रहे थे कि हमने ये सोचा भी नहीं था कि ये 5-6 चीजें होगी वो हुई थी. So we just want to present what happened underneath the headlines for a bit, and then we'll give you a sense as to what we think the overarching narrative जो CY24 के लिए हो सकता है. तो first and foremost, I think this is a very important slide because हर साल का जो ये exercise करते हैं over the course of the last almost 43 years that we have data of Sensex, मोटा मोटी roughly about 10 ही साल ऐसे हुए हैं जहां पे नेगेटिव रिटर्न्स मिले हैं. एंड ऑब्वियसली उसमें एक ही साल है जो भयंकर नेगेटिव रिटर्न दिया है, 2008 का जो साल है. एंड बिटवीन -15 to -30 you had 6 years, most of them in the 90s, you can say, and early 2000. And then in the last 10 years we've had only 1 year, or rather last 10 years तो कुछ भी नहीं है, but 2011 पे एक बार हुआ था. And then you've had by and large reasonably positive years. Obviously, as many of you will know the headlines, कि ये 8वां consecutive साल था जहां पे मार्केट ने पॉजिटिव रिटर्न दिया है. एंड obviously everybody counters that कि ये साल will it be a continuation of that 8 years, meaning 9 consecutive years, or are we going to see some kind of a different performance compared to what it has? So I think by and large, we have had thankfully reasonably positive outcomes in the last 40 odd years, and that should help frame your discussions with your investors from a slightly longer term perspective. So I think one of the key aspects कि 2023 में इतना strong return क्यों मिला, I think is that economic activity और GDP का जो growth है, it was actually much better than what was projected say a year back. Be it that of a world जहाँ पे 2.1% से 3% का GDP, and ये real terms पे GDP growth है, primarily led by US, जहाँ पे ऑलमोस्ट फ्लैट का एक्सपेक्टेशन था यही टाइम पिछले साल, एंड दे इवेंचुअली एंडेड अप डूइंग अबाउट 2.6%. India, of course, was under strong economy जहाँ पे growth surprised on the positive. लोगों का expectation 5.8-6% के आसपास था, और what we eventually did was close to about 7%, and therefore there was a significant beat. The big negative surprise अगर बात किया जाए तो वो चाइना का था, जहाँ पे there was some amount of underperformance in terms of expectations. So this was one of the key reasons क्यों markets across the board kind of followed through. This was also a time frame, अगर आप देखोगे कि markets across the board ने अच्छा किया. This was also a time frame जहाँ पे assets like gold did quite well, assets like Bitcoin did quite well. So this was a very different market जहाँ पे risk off के जो एसेट क्लासेस है उन्होंने भी पार्टिसिपेट किया, रिस्क ऑन के जो एसेट क्लासेस जैसे कि टेक, नैस्डैक हो, बिटकॉइन हो, दैट आल्सो पार्टिसिपेटेड क्वाइट सिग्निफिकेंटली. सो in that sense, typical जो correlations होते हैं asset classes के, it kind of broke down, and that was also because 2022 was one such year जहाँ पे both bond and equity globally had a very terrible year, right? Now this is an interesting chart from an Indian context. देखिए कि from an India point of view अगर देखेंगे तो Nifty, as we told, was gave about a 20% return. Let me see if I can. निफ्टी गेव अ 20% रिटर्न, बट इतने सारे इंडाइसेस है जिन्होंने 20% से ज्यादा रिटर्न दिए हैं. स्टार्टिंग ऑफ कोर्स विद रियल एस्टेट, PSUs हैड अ वेरी गुड रन, वैल्यू डिड एक्सीडिंगली वेल, कंटिन्यू टू इट्स स्ट्रॉन्ग रन, एंड उसके बारे में हम एंड में बात करेंगे इन टर्म्स ऑफ वैल्यू vis-a-vis ग्रोथ. मिड कैप्स एंड स्मॉल कैप्स, ऑटोज डिड क्वाइट वेल. बट यही चीज अगर हम ऐसे देखेंगे, so if you look at it, over the last 3 years, from 21, 22, and 23, more than 50-60% of sectors actually outperformed NSE 500. This is actually a very rare case जहाँ पे इतना सारा breadth कि आप एक top down view रख के you people have made significant amount of money in terms of English. Okay. In terms of returns that came through. So that is as far as the overall breadth of the market, right? Now coming to the next aspect, which is in terms of if you look at the breadth of the market. This is again an interesting slide wherein we are talking about from 2001 onwards. How is the market cap share between large cap companies, mid cap companies, small cap companies, and micro cap companies? So if you look at the market cap share, in 2017 end, large cap companies, which are the top 100 companies, accounted for about 68.9%. That has come down to close to about 67.2%, right? So that it's seen a reasonable amount of shift going further into mid and small and micro caps. But if you were to look at the large cap companies' earnings share, that has actually gone up during the course of the year. It is currently at about 71.5%. So in some sense, despite very strong earnings coming through large cap, we've actually seen a greater shift happening to mid, small, and micro cap companies, and therefore, clearly from an earnings point of view, we think a greater comfort continues to remain in large cap. Another interesting slide that we made out. Obviously, we are all in the business of creating a relative alpha compared to that of the benchmark, right? Now, if you were to look at the number of companies within the top 500 companies, so 500 कंपनियों में से the number of companies or the percentage of companies which give a 10% alpha. So it's a significant amount of higher alpha compared to that of NSE 500. Last year, we closed to about 50%. If you really look at it, these are all levels wherein generally markets breadth kind of normalizes. Now, again, what can be the catalyst, etc., is something that we'll come through in a bit. But risk taking has got rewarded significantly during the course of the last year, which explains this very strong move, wherein almost 50-60% of companies actually had more than a 10% alpha. In fact, if I were to look at the other end, which is what is the percentage of companies which give a minus 10% alpha, that number is close to about 10 or 12%, which is one of the lowest that we've seen over a long period of time. So risk taking got rewarded very, very well last year, and therefore we do think whether it's going to continue to sustain in the years to come is something that we really have to think about, and we have some thoughts when we discuss to you about how we expect 2024 and beyond. one of the key aspects that I have seen, over the course of the last 20 years, the first 10 years when I was based out of Singapore, and the last 10 years in Bombay, whenever we used to speak to foreign investors, India is doing well, etc., etc. Most foreign investors used to always say कि आपके जो companies है, they are extremely good. There are some very well managed companies. Your blue chips are exceptionally well run, globally competitive, etc. But the one area where people always used to have problems were with macro. That we were part of the fragile five. That there are very large bouts of currency depreciation. Inflation can keep coming up very strongly, etc., etc. And therefore, that was always a bone of contention, so to speak, for foreign investors. I think what we've seen over the course of the last 4, 5, 6 years is that macro has got significantly better, and over a period of time that appreciation of the macro has got even better. So what we have plotted out here is this is for the rupee, right, against the US dollar. What we plotted out is the high and low for the year, the range, right? And like that we have plotted for about 15 odd currencies, the 15 major global currencies. And the high and low for the rupee is at the lowest decile compared to many other countries. So the ranges have become smaller and smaller, which means it's becoming far more predictable for both importers, exporters, for both foreign investors. And therefore, over a period of time, this appreciation of better macro was possibly leading to a higher multiple or a higher appreciation of management teams in the Indian side, or rather a lower risk premium, so to speak. So this is as far as the rupee is concerned. This is the same thing for the 10-year GSEC. Right. Over a period of time, again, that has started coming down compared to many others. Of course, we all know that, for example, in the US 10-year, the last year, while overall was flat, yeah, it had a huge gyration. It went down first, then it went up all the way to 5, and then it came off to close to about 3.75, 3.85. So there's been big swings in the global markets, but Indian swings have been far, far, far less pronounced, and therefore, I guess that also helps in overall risk assessment of the overall markets. The last slide that we have on 2023 is that while volatility was generally lower, okay, there were few days which if you missed out, you missed out on a lot of action. So what we have presented here is this line is the actual returns of NSE 500 for the year. Returns were about 24.3. But if you had sat out the best 10 days, out of the 250 odd trading days that were there, one would have got only 11% return. Right. Similarly, if you had avoided obviously the worst 10 days, you would have got almost a 40% return. So in effect, obviously predicting which are those 10 days that you have to sit out and which are the 10 days you have to buy in, etc. Is extremely difficult. I don't think anybody is capable of it. But the point is, this constant fear that one has when markets become a lot volatile and some news flow comes in. If you were to just hold our nerves and stay invested, I think the overall experience that investors have is a far more predictable and a far more pleasant experience compared to these outcomes that many others try to get. So this is broadly how 2023 has kind of panned out. To kind of summarize, a very good year for 2023, more so in the breadth of the markets, mid and small caps ka jo extra risk taking got significantly rewarded. Disproportionate reward happened for the mid and small caps. We've seen the breadth of the markets, both in terms of the number of sectors that outperformed, has been significantly higher than the averages. We have also seen the number of stocks which give as high as a 10% alpha was very strong at about 50% higher returns. So all in all, it's been a good year, so to speak, that we're coming through, also led by the fact that India's macro conditions got significantly appreciated. So this is, of course, क्या हुआ पिछले साल का and what we can make out from that. But if I were to look at what is likely to happen in 2024 and beyond, So broadly, we have a three framework, right? Markets in the medium term are driven by one, earnings, two, liquidity, and three, sentiment, right? And obviously, an interplay of each of these three variables is what drives the medium term market structure. So, in that context, let's start taking first the earnings multiples, or the earnings, or the value, or the fundamentals, right? Now, if you were to look at how the overall GDP, profits to GDP of the listed companies have tracked, obviously from in the period from 2002 to 2008-9 was a heady period jahan pe the overall profits as a percentage of GDP went up significantly. So even as GDP kept going up, the profits that accrue to the firms, to the shareholders went up significantly. It almost doubled from about 2.6 to about 5.1 before the global financial crisis happened. And from there, it came down all the way to about 2.8, almost the same as 2003. Then, of course, COVID happened, wherein there was significant losses, etc., in a certain set. And from there, we've seen a reasonably strong bounce to about 4.7% of overall GDP. We do expect this to continue its upward trajectory going forward. Possibly we'll get back to that 5.5%. Obviously, over a period of time, more and more firms have got listed. जो unorganized to organized का जो shift हो रहा है, I think more and more of that is getting captured by the listed firms. There is another chart that we'll show you in terms of how the overall country is formalizing. So we do think that in this cycle, possibly listed entities will tend to have a greater share of GDP than what was there in the previous cycle. So that is as far as the medium-term construct of valuations or of fundamentals is concerned. In the slightly more near-term basis, in this period from FY20 to FY23, or FY24, if you were to look, broadly earnings went up by about 30% CAGR. Right, there were some very strong years, especially FY22 was a very strong year. FY24 also is likely to end up to being a very strong year. Going forward, we do think that this wherein earnings more than doubled during this 3-year phase, we think that the next doubling can happen in over the next 6-7 years, which is not bad. But obviously, the pace of growth that we have seen in the last 3 years, जहाँ पे unorganized to organized, margins went up significantly, pent up demand came through in a lot of sectors, etc., and stimulus from government came in, both globally as well as in India. I think so. All of these are more factors that helped boost the overall profit pools. Going forward, they are going to moderate. So we are not going to see that heady 30% kind of a CAGR, but we are likely to see more like the 13 to 14% kind of a run rate over the course of the next 2, 3, 4 years, which is not bad. But compared to what it was, obviously, of the past, it's going to be much, much lesser. So that's as far as the earnings picture is concerned. Coming to the liquidity aspect, obviously we all know and hear about the domestic institutional investor, and we've got a detailed section on that I'll take you towards the end of the session. But I think DIIs and the SIP flows, etc., are very strong. That is a known story. But what is starting to come through is the FIIs, right? So I think last year was a very strong FII year. Close to about $20 billion came in during the course of the last year. And I think, despite that money coming in, if you were to look at overall FII ownership, as against, say, the index, etc., it has actually come off quite meaningfully, even though you saw a good increase in the last year or so. Overall, from the highs of about 24-25% of the overall market that they owned, it has come down to about 21% in BSE 200, and for the overall markets also, from about 20%, it has come down to about 17 odd percent. So there still is room for FIIs to increase. More importantly, India's weightages in benchmarks like MSCI and FTSE have gone up. So I think the extent of over ownership that foreigners had in India It's a lot lesser now. So, and we do think that, especially with the weakness in dollar index, should help in greater flows coming to emerging markets. And with that, India should also get slightly higher allocation coming in. Now, while we have got buying coming from the SIP-led domestic institutional investor mutual funds, and you've got buying by FII, there are two entities that are selling out, right? कि हर trade में एक buyer और seller है. The sellers are primarily VC private equity firms which invested significantly in the period from 2016 to 2020, and now they are cashing out. So that is one set of investors. So we saw almost a 15 to 16 billion dollars of selling last year. Along with that, promoters are also using this rally to sell stake. So we've seen significant promoter selling also during the course of especially the last 6 months. So in totality, we don't think that liquidity beyond a point can only drive markets. You are going to see, while we continue to remain positive on liquidity, we think that that alone, especially in the last 2 3 months where we've seen significant flows coming in by foreign investors, that is likely to moderate. So both in earnings as well as in certain sense of liquidity, we are in a good zone. But clearly, I think where we are most vulnerable is in sentiment. Today is a point in time where India is at its best uh, in terms of sentiment, be it in terms of say global sentiment with respect to China bashing and all of that is happening. Also with respect to the political stability that's likely to come through, given whatever trends in elections, etc., that we are going through. You're also in a phase wherein, compared to the rest of the world, India is in a much better shape. And therefore, it is pulling in more of thought leadership, more of FDI flows. You are seeing, say, Apple, now possibly even Tesla coming in to manufacture in India, etc. So the fear that we have is key, sentiment can change on a dime, right? And today it appears that we are in the best setup for sentiment. So, in some sense, we think that all three factors, earnings ho, liquidity ho, or sentiment ho, they are all in a zone jahan pe the best is currently where we are. Going forward, while it's still positive, but the pace of each of these is going to be a lot moderating. And therefore, we think that markets will have to digest each of these three variables as they soften out. So from earnings point of view, like I said, we are expecting anywhere between 13 to 15% kind of a growth. Liquidity, we continue to see strength coming in from domestic institutional investors. FII may be slightly higher, but that is more than matched by promoter selling. Maybe the government disinvestment program can come through, etc. And then on the sentiment, we really are at the best zone, extremely vulnerable to something going wrong both globally as well as if something happens within India. So it is in this context that we need to assess key how much of it is already priced in by the market. So if you look at it from a Nifty point of view, things are not that bad. We are still only at a 5-year 5% premium to the long-term earnings that we have over the course of the last 15, 17 years. And therefore, by and large, I think we are okay from a large cap point of view. But the real problem starts coming through when we go lower down the curve. So what we did at this here is ki 3 saal, that is from FY20 to FY24. We saw how much of earnings came in the top 100 companies, which is large cap, 101 to 250 companies mid cap, 251 to 500 companies small cap, and 501 to 1000 companies, which is micro cap, right? By and large, if you look at it on a 3-year CAGR or a 3.5-year CAGR, you've got roughly similar kind of earnings growth. Large caps are given at 26%, mid cap 27, small cap 25, and micro cap 25. So it's been very strong earnings growth, right? But the expansion in multiples, so in large cap, actually it is negative, so it has got derated. But as you go lower down the curve in micro caps, for example, almost you can say 60%, 70% of the return jo mile hai micro caps ke, that has primarily come in from multiple expansion. So this to our point is, where we get a bit worried, especially in the micro cap segment, slightly more in the small cap, slightly less in the mid cap, and of course in large cap, we've seen a derating. The same thing over the course of, how valuations stack up. Today we are in a zone jahan pe valuations broadly are in each of these segments roughly similar. Though if I were to look at the 10-year average, which is this dot, generally micro and small cap typically tend to be at a discount to large cap. Today we are at a zone wherein all of them are actually at a premium to overall segment. So clearly from a valuation point of view, a lot of this good news of very strong returns, very strong economic growth, etc., is, I would think, reasonably priced in by the markets. Another way of looking at it is earnings yield, which is 1 by PE, right? We are in that zone, jahan pe, if you look at it, 2017 was the time frame, end of 2017, wherein we had small and micro cap earnings yield or PE more than that of large cap. We are again in that similar zone wherein on a trailing basis, they are now at a negative compared to large caps. This is another interesting chart, which I think we use quite usefully in asset allocation. So just to explain this construct, ये chart के लिए, what we do is कि totally on any given day, on a say a smoothened kind of a thing, we see कि let's say that in NSE, close to about 50,000 crores of cash volumes happen. Out of that 50,000 crores cash volumes, how much is accounted by the top 100 companies, right? So now typically what happens is in good times, when people are very greedy, more and more of the trading also happens outside the top 100, because obviously that is where the excitement is, that is where new ideas, etc., start coming through. And typically on the other end, when we are in a crash, when you are in a significant pressure, you generally see, for example, in COVID lows, etc., almost all of the trading is concentrated in the top 100 names, right? So if you think about it, during COVID lows, almost 71% of all, almost 78% of total volumes were accounted for by NSE 100, the top 100 companies. Whereas currently that number is close to about 35, 37%. So we are in a zone where typically a lot of trading, a lot of action is happening in the small, mid, and micro cap space. Lesser is happening in the large companies. Growth is continuing to be strong in all the segments. Valuations are a lot less on a relative basis compared to other segments. And therefore, we do think that larger companies, of course, have a better risk-adjusted return potential. That doesn't mean that mid and small cap cannot give you returns. Obviously, for a long-term investment, which is more than 5 to 7 years, for an aggressive risk taker, it does make sense to have an asset allocation into mid and small caps. But for a lot of conservative first-time investors, etc., we do think that there are other products, including larger companies or flexi cap, etc., where we do suggest investors to come through. Now, there is this growing question key, value over growth. And last 3 years, clearly value did exceedingly well. PSUs ho, aapke defense ho, utilities ho, etc., etc. Right. Now, what we have done here is 3-year rolling returns of value over growth, which is basically, this is basis quant framework. कि top 200 companies में we sector neutralize it, which means same weightage for banking, same weightage for IT, same weightage, be it within the top 200 companies, right? Within that, then we break it into which are the stocks which are more value oriented and which are the stocks which are more growth oriented, right? And then you create different series. So this is very academic in some sense. But if you look at it, over the course of the last 23 years, 10, 12, 13% alpha on a rolling 3-year CAGR basis is where value typically tends to kind of, roll over. We are in that zone where it has happened. If you look at in 2018, 2019, wherein, growth did exceedingly well, we have gone the other direction now. We do think that, potentially growth as well as quality at a reasonable price can see reversal coming through over the course of the next 3-4 years. Again, it's very hard to time any of these. ऐसा नहीं है कि next month onwards, value will underperform and growth will take over, etc. But on an allocation point of view, we do think going forward, growth and quality at a reasonable price is what is likely to do well. We've already seen in US, for example, that last year itself, growth has taken over from value. We do think that in India, possibly over the course of the next 12, 18 months, we're going to see greater shift coming in from value to growth and quality at a reasonable price. It doesn't mean ki you buy at any price, but at a reasonable price. From a theme point of view, these are the 4 themes that we are positive on. We continue to be positive on domestic manufacturing. This is a space where we have actually started seeing after a 10-year cycle, capex starting to move up. So for 10 years, 6 lakh crores of total capex by private companies used to be the hurdle rate. We crossed that in 2023. We do think that in 2024, we'll be close to about 8.5 lakh crores. There is strong possibility that in this cycle, we could be at 10, 12 lakh crores before the cycle turns over. Why do we say that? We think because cash flow from operations, which is profits, is currently at 14 lakh crores. Profits before COVID was at about 6, 7 lakh crores. So we are now getting into a zone where there is so much, a lot of profits coming through. I think all of those profits will find ways of getting into some form of capex, some form of buyouts from companies, etc. So this is a space that we continue to remain positive. If you look at, say, capex to depreciation, which is this green line, it went zoomed up to almost as high as 5 times. The extent of depreciation, and that came down to close to about 1 time. Basically, 2018-19-20 में there was only depreciation led capex. Basically maintenance capex. There wasn't any growth capex. Now we are starting to see that reversal coming through, wherein we are starting to see some offshoots of capex geared for growth. So this is a space, be it in textiles or auto components or mobiles, all of these, there are multiple initiatives, including PLI, etc., that's coming through. We spoke about Apple, for example, making its manufacturing. They're talking about 5-fold increase coming from India. So whatever we are talking about, China plus one, Europe plus one, I don't think it's just a narrative anymore. There is actual evidence in the ground, be it from the Morbi cluster. अगर आप Morbi का देखोगे तो tiles has almost doubled. Export of tiles has almost doubled in the last 5 years. All by small entrepreneurs. There weren't any Tatas, Birlas, etc. No large companies. But across the length and breadth of Gujarat, from Morbi, we've seen almost a doubling of exports coming in from tiles. And today, India is the largest tile exporter in the world. So we are starting to see multiple levels of this happening. And we continue to remain overall positive on the space. Coming to the consumption is where I would say some question marks are there, especially at the bottom of the pyramid. But this is a very interesting chart that I would urge you to look at. So basically, if you were to look at, the labor, that is, salaries, etc., kahan se milte hai? In 10 years back, in 2012, almost all the salaries that all of India used to get was primarily coming from the government. Right, they used to be almost 13% of GDP as salaries coming from the public sector, state and center put together. Right, this line is the private sector. All your it obviously includes listed companies, but even unlisted companies which are in the private sector, and this includes all your unorganized or household sector. So as they say, right now in 2012, both of them were almost touching each other, right? You had a dominant government salary bill, and then you had similar equal measures of both organized sector and unorganized sector. Now, look at what has happened in the span of 10 years, right? In the span of 10 years, we have seen, for example, last 2 years, organized private sector is actually now bigger than your salaries from government. And unorganized has come off quite meaningfully. So what we are talking about formalizing of economy, all of that is starting to happen now. As this happens, we generally do see discretionary spending come through. So if you look at this, this is from 1980 till now. What used to be 15%, more and more is going to discretionary. Now, in the last 2 3 years, of course, because of high inflation, it took a knock. This is during COVID, and it is not yet fully recovered. But we do expect this trend to continue to keep growing through. So while there is a near-term issue of consumption, we do agree to that. We think that from a longer-term or a medium-term perspective, this is a good time to buy into a lot of consumer discretionary names. So our fund, for example, the Gen X fund, is very ideally positioned for those who want to build a slightly more medium-term kind of a portfolio. The third is, of course, financials. This is a space that has surprised many because currently all of the metrics are very good, be that of credit growth, be that of margins, be that of NPAs. And yet we have seen some of our larger companies on the private sector, especially banking side, not perform as well. Whereas public sector and smaller companies or smaller banks from losses have started reporting very strong numbers. We think that this is again an opportunity for investors to get back into private sector. Whether it is going to play out this year, possibly may happen because of the strong underperformance, but we think that again from a 2 3 year out perspective, this is again a space that I think one can buy into through our financial services fund. um, Last is, of course, the digital stack, be that happening in India, a lot of government initiatives that are happening, or in terms of the overall IT services. Jahan pe obviously people are very worried about a recession, but I think our competitiveness has gone up meaningfully. So I think in both of these counts, there are a lot of opportunities. Our digital fund is very well positioned over there. So that's again a space that we would urge you to look at. So in summary, we think that, while obviously we have put in numbers, and as I said at the start, these numbers are to some point giving more a direction rather than precision. So we do think that compared to last year, we are going to see a lot more moderated returns. It still is going to be positive. But we think that investors definitely have to come with a longer term horizon in equities, more so in mid and small caps. We think large caps are in a better position than mid and small caps. Fixed income, our colleagues think that actually this year could give you slightly better returns than last year. So this is a product wherein we think that returns can be slightly better compared to last year at 8 to 9%, and we are reasonably constructive, but it's still a reasonably moderate return. Gold, we think, can continue to give you a reasonable single-digit kind of a return from an overall perspective. From a product bouquet point of view, obviously at this point of time, given valuations, we are more suggestive of coming in through the SIP mode. From a conservative standpoint, obviously our asset allocation products, both the BAF and the MAF, make sense. For moderate investors, we think Flexi is ideally positioned. Currently, about 70% is in large cap. Equity Advantage is another fund wherein you've got about 55% in large cap. Yeah, and then you've got basically, the Gen X fund, which I mentioned, is where one can look at. From an opportunistic point of view, these are the funds that we think. Business cycle, I'm personally very excited about it. This is a fund wherein, as we explained, we are making some significant shifts in terms of the portfolio construct. Currently, if you were to look at it from a sectoral point of view, we think that there can be four dark horse sectors: pharma, consumer durables, we think metals, and media. These are the four dark horse sectors, which can try and surprise investors over the course of the next 18-24 months. The business cycle fund is reasonably well positioned and adding to its exposure in these categories over there. So we do think that this is an opportunistic time for investors to get into the business cycle fund. I know the experience so far has been a bit underwhelming, but we think this is a special call out at this point of time, apart from our other funds, for investors to take notice, and to try and get into this fund, business cycle fund. So I'll just take 2 more minutes because I think this is important from a distributor point of view. There is generally a sense कि बहुत पैसा आ गया है domestic investors का. So it is important to therefore have a holistic sense as to how much money has come in and where are we in this broader cycle of household asset allocation. So if you were to look at it, this is data that we have. Total wealth of households is close to about 900 lakh crores. So it has obviously grown quite significantly. But if you were to look at it, in March of 2008, close to about 4.2% of this total assets was in equities. That came down to 2.2% in those 5 years post the GFC. There was that paralysis phase, etc. And then demonetization happened, and then we've seen it coming back to the similar level as where it was in 2008. But more importantly, if you look at the cash which is lying in households, almost 75% of equities is in cash, which is earning nothing. It's a very, very big amount. Even out here, if you were to look at it, this amount which is there in bank deposits is quite significant. Right, it's almost 4 times the size of what is there in equities. And this equities is not only domestic mutual funds, it includes all kinds of equities, direct stock accounts, etc., EPFO, etc., of household savings which get into it. More importantly, our physical assets, both in terms of gold and property, is significantly loaded out here in the form of physical assets, right? So this is one observation over a period of time. If you look at how countries like US, etc., have gone through, they've gone into the completely different direction, wherein financial assets are accounting for almost 70-75% of total assets, and within that, equity is almost a third, right? So significantly higher amount of equity allocation, right? Now, this is a very interesting study because most of us, when we look at gold, real estate, bonds, or FD, etc., obviously they do provide in stability and low volatility. So FD's volatility is only 1%. This is, of course, on an annual volatility basis on a rolling 5-year term. This is a 25-year kind of a study, right? Equities typically tend to have higher volatility, without a doubt. Gold also does have reasonable volatility, but look at the times where it doesn't beat inflation. It is not very different on a rolling 5-year basis. All of these asset classes have roughly a 25 to 30% probability in the past that they have not beaten inflation, right? So are we being very safe when we allocate so much into cash, so much into gold, so much into FDs, wherein the chance on a 10-year basis, for example, almost 1/4 of the time FD में जो पैसा लगा हुआ है doesn't beat inflation, whereas that number comes down quite meaningfully down to equities. So this is one point that we've got a lot in cash. Almost 75% of the total money which is in equities, almost that much is there in cash at household level. We have a lot in gold. We have a significant amount in FD. And then we said that, if we look at the same returns of this returns that we have got in a rolling 5-year basis from 2018 to 2023, and we don't touch the property part, the physical assets, we just move the financial assets into either 70-30, 70 in equities and 30 in bonds, or 70-20 and 10. Okay, we are seeing almost a 1.5% increase in CAGR, from 8.5% to 10%. So effectively, our allocation to cash and to FDs, which constitute almost 18% of overall household asset allocation, is dragging down the overall returns by 1.5%, almost a 55 lakh crore reduction in total wealth that came in because of these allocation. So the point we are trying to make is that, in a holistic sense, there is a lot more that can happen to come into financial markets, not only to equities. It can be into the bonds, it can be into our debt mutual funds, hybrid instruments, etc. This is again just our sense that we think that equities, which is currently about 43 lakh crores, the total ownership over a period of time can tend to be very, very large, right? In a 10-year period, we think that overall equities can be close to about 10%, because we've seen that with greater, GDP levels, greater savings, more of that education, more of handholding by distributors like yourself, we are seeing a greater shift coming into various financial assets. And so while real estate, etc., can continue to do well, we think that as advisors, the potential is a lot more higher for investors to come into various financial assets, including that of equity mutual funds, including that of fixed income mutual funds, or into hybrids like multi-asset allocation products or balance advantage funds. So with that, I'll kind of stop here. I think I took slightly longer than I anticipated. We can take over any questions that any of you may have. Thank you.
Yeah, thank you, Harish, for running us through the annual outlook. So I hope time will permit us to take few questions, right, Harish?
Yes, please. I've got about 15 minutes, so happy to take any questions.
Meanwhile, request audience to type in their questions in the Q&A section. And in the meantime, as the questions pour in, Harish, I'd like to start off with a question which I think most people will have on their mind, which is with approximately 50 to 60% of the global population goal bound, how we as fund house viewing it in terms of opportunity or uncertainty.
50 to 60% getting old. Is that?
No, they are poll bound.
Okay, elections. Sorry. Yeah.
Correct.
So that's right. So I think, this is a good point. We are getting into an election overdrive in this year. A significant amount of countries are going for elections. Typically, what we have seen is that neither the policymakers in terms of monetary policy, they don't want to upset the apple cart, because obviously elections ka sawal hai. Similarly, even in terms of say fiscal, which is the government side, typically tends to be slightly more favoring in terms of a stimulus. So therefore, we think that, which is why we think that it's unlikely that we're going to see a massive recession. At best, it could be more likely towards a soft landing rather than a recession. And therefore, it has got implications of equities. It's got implications for fixed income as well. We do think, therefore, that, global growth may not necessarily collapse. And therefore, we do remain constructive on markets from a medium-term perspective, both on equities as well as on the fixed income side.
All right, Harish. So many people have also asked that we have touched upon the sectors which we are bullish on, or maybe we have given our point of view. But what is it in terms of market capitalization? How are you looking at large caps, mid caps, or small caps? Will mid cap and small cap be still of interest to investors? How are you looking into that?
Yeah, I think the last 6 months, pretty much all fund houses, or most of them, I think, have called out for large cap over mid and small cap. So I don't think we are any different from that perspective. But I think it's important as to why we think so, which is what we have said, that, earnings growth across the board is not going to be very different from large over mid and small cap. The multiple, on the other hand, has significantly got re-rated for especially micro caps, small caps, and to a certain extent into mid caps. Therefore, we think that the larger companies are better, have a better promise at this point of time for allocation. Will this work out in the next 6 months? I don't know, quite honestly. Also, it is important to remember that today cash in small cap funds, cash in mid cap funds, etc., totals to close to about 1 lakh crores. So we are not going to see a massive kind of crash. But like I explained, we saw a complete appreciation of risk taking last year, wherein almost 50-60% of companies gave almost a 10% alpha. Generally, periods after that typically tend to be a lot more polarized. You're going to see smaller pockets, lesser number of stocks, lesser number of sectors going to do well. And in our view, those are going to be far more in larger companies than in the smaller companies. So, from a slightly more near to medium term, we think that large caps offer the better risk return for an investor point of view. And that is how we are positioned in our funds as well.
So someone has also asked about our outlook on PSU equity fund.
On PSU equity fund, is that right?
Correct.
Right. Okay. So I think obviously PSUs have done exceedingly well as a fund house. I think Birla was extremely well timed NFO that came in close to about 3 years, and it's done exceedingly well for its investors. With a strong rally behind, obviously things are going to be a bit more moderated. But the good thing is, they still have dividend yields of anywhere between 5 to 6%. Most of the companies, not all of them. Um, you also have a reasonable amount of visibility in terms of order books in a few cases, which are running into say 2, 3, 4 years kind of revenues as order book in certain capital goods, defense kind of sectors, etc. Are they extremely expensive? Possibly not. I think the one segment within that which is extremely expensive is on the defense side, but rest of the PSUs still are reasonably okay. So I think it's going to be a little more specific now. Last year, any PSU I think has got re-rated massively. This year, it's going to be a lot lesser. Within that, if you ask me, I think pockets like say metals, pockets like say capital goods, maybe to a certain extent banks are likely to be better poised than names, for example, in railways and defense, which have got significantly re-rated over the course of the last 2 years. So it's going to be a lot more stock specific or sector specific this time around. But over a 3 year period, we continue to remain positive on the overall space. But clearly, returns will be a lot more moderate from here on.
All right. Apart from the PSU sector, the infrastructure sector also seen a boom. So, what are our views on the infrastructure sector going forward?
So, like I mentioned, both the manufacturing and infra is in a very sweet spot. Infra, broadly, four engines are there. First is government spending, second engine is private capex, third engine is real estate, and fourth engine is PPP, which is public-private participation. At this point of time, government capex is on fourth gear. I don't think it can improve further from here. Of course, government is continuing to spend on infra, which is very good, but we are not going to see any significant acceleration out there. Where we are likely to see acceleration is clearly in terms of private capex and real estate. Both of them we are starting to see, like I mentioned, in private capex, after 6 lakh crores for the last 10 years, we have started move, we crossed 8 lakh crores. My personal sense is over the course of the next 2, 3 years, possibly we are going to cross about 10, 11, 12 lakh crores. So there is still room for private capex to come through. Obviously, it's a function of many things, but I think balance sheets are good. Overall cash flows are strong, and so companies will spend more and more into capex. Real estate again is in a very good spot. I think over the course of the last 10 years before COVID, if my memory serves me right, we used to do something like I think close to about 20 million square foot or something of residential launches. That has gone up by almost 50%. I think this is again a space wherein it's looking quite good. We still have a long way, and these are asset classes, that don't stop after 2 3 years. They typically take a lot longer in terms of the cycle to end. PPP is still some time away, so I think it's only when all the four engines fire that is when I guess we start getting very worried. So both on the manufacturing and on the infra, we remain reasonably positive across most of our diversified funds. Also, we have a larger bias towards investment than in consumption, where we have greater overweights on. So I think we are positive across the breadth, but again, like in every other segment that I said, I think returns have been so strong in the last 2 3 years that one should expect time correction for sure, and one should expect a reasonable amount of moderation in returns over the course of the next 2 3 years.
Harish, one last question. So with the interest, lowering of interest rate is just on the horizon. So will it lead to increase in liquidity and lead to overvaluation?
It's hard to say, but I think at a base level, is there froth in the market which can lead to overvaluation? That happens when there are only buyers and very little sellers. So as we have seen, we've seen selling coming in from private equity, venture capital. We've seen selling coming in from promoters as well. Maybe we'll see more divestment coming through. So I think there are counter levers against this significant overvaluation kind of a construct. At the end of the day, earnings have to deliver for markets to justify. So we can't be having just a one-way kind of a thing basis only liquidity and interest rate cuts. So I don't think we are going to see a massive kind of disconnect. Like I said, broadly, if I were to look at even from a 3 year perspective, if I'm not wrong, earnings have gone up by 30%. Market cap of these 1,000 companies have gone up by 32%. So it is not that it's not happened overall. Like we discussed, a lot of that is because large cap have got derated to a certain amount. Mid, small, especially micro, has seen a significant amount of re-rating. So overall, there is some sanity. Can that change? Well, who knows? But we think that we at least that's not our base case, that we can see a further melt up in markets wherein regardless of fundamentals, we continue to see under 30-40% kind of a growth in overall returns for investors in the near term.
All right, Harish, thank you so much for your time, and thank you, friends, for joining in this first session today, and hope to see you again in the month of February with our monthly market outlook. Thank you and have a wonderful evening ahead.